I thought I'd do today is just walk through quick agenda. So today I wanted to talk about some high net worth demographics that we're seeing in Canada specifically. I really want to concentrate on the advisor's role and advice in this segment and what we're seeing within the advisor space with high net worth clients in Canada. I'm going to give a quick overview on how Manulife Private Wealth fits within the world of independent advisors and how we can help enhance your practice. And then I want to talk about why high net worth investors are looking for something slightly different, and why it's really important to continue to evolve your practice in order to be able to get out in front of what high net worth investors are looking for. Then we're going to pivot and just walk through what Manulife Private Wealth does, just so people are familiar with who we are. And then lastly, if there's time at the end of it all, we're going to do a quick Q&A. So I'll start off by an introduction. My name is Glen Brown. I'm the head of Manulife Private Wealth. I'm based in Toronto, beautiful, rainy, miserable Toronto today. I hope things are better in Winnipeg. On the call today from my team are Janine Perzan and Scott McGillicuddy. They're based in Calgary. We have offices in Calgary, Vancouver, Toronto, Montreal, and Quebec City. And obviously, I think most of you are familiar with Manulife. So why don't I get a start on just some high net worth demographics and some information which I think you might know some of, but you might find it quite interesting just to see the level that high net worth has been concentrated within Canada. So within households in Canada, when you look at it, it's interesting to just sort of demonstrate that 5% of Canadian households represent 71% of Canadian total wealth. Now, I want to put a couple caveats on that. One, it's a lot less concentrated than you would see in the United States, where in the United States, it's, the top 1% are maintaining almost 90%. The other thing is this is total Canadian wealth rather than just investable assets. So that's really important to call out because most Canadians' wealth are not tied up in investable assets such as stocks and bonds. They're actually tied up in assets such as their businesses. And that's a really important distinguishing point. But it's really important for advisors to think of that when they're thinking about their own practice. The other thing we're seeing is continued increase in the share of net worth. So when you look at 2026, they're forecasting that the high net worth segment will make up 88% share of investable wealth. And why is this an important number? Because obviously 88% is going to be in the high net worth space. That means the remaining wealth is being fought over is only 12% in the mass affluent in the retail space. So it's really important as an independent advisor that you can position yourself in such a manner that you're getting your potential share of wallet. And where's the problem in that? The problem right now is when you look at the asset mix and who's managing the assets, the top pie chart that you see on this list is the full distribution of wealth. You can see that the independent financial advisor, which is in the top, and I'm colorblind, so I'm going to guess it's green, but it could be orange, is about 12.4%. In the high net worth space, that falls down to 5.59. And this is an important subset because when you look at full service brokers, deposit takers, private wealth management, and online discount brokerage, most of those aggregate is combined into the big five banks. And so overall, the big five banks' market share is approximately 80 to 85%. And it's really important to realize that that's what you're fighting against. And it's a natural consolidation that just takes place in Canada. We have a propensity to both love and hate the banks, but it's really important that you're positioning yourself because one of the challenges we see in the independent advice channel is once there is a transition event, the big banks are very good at pursuing this asset. So what we're trying to concentrate on is trying to make sure that the independent advisor has the ability to compete and actually maintain relationships. Just some information on the high net worth market. This data is coming out of Environics. It's available to anybody. And just as an aside, this deck will be available in case anybody wishes it again. But it gives just a quick overview of where the number of millionaire households are situated. This one's pulled from Manitoba. It is from 2019, so it's fairly valid. But it just gives you an idea by postal code where you can actually see the high net worth clients within your own sort of backyard. So gaining share within the high net worth market segment. Well, what are you thinking about when you're thinking about high net worth opportunities? I mean, the first thing that jumps into my mind, obviously, is the baby boom generation. There's a huge transition of wealth going on right now, and it's a highly concentrated amount that's available with them. But I think one of the things that often is misunderstood, and it's misunderstood by many advisors, is that when you're focusing on your clients, the biggest wealth transfers that generally take place are business sales. And we've been seeing it aggressively during the pandemic, which has astounded me actually. But the number of business sales that have been taking place during this pandemic has been continued and ongoing. And what we see a lot of the time is that an independent advisor has probably had a relationship with these clients for a number of years. They've probably done their life insurance, they could have had their RSPs, and they've done a great job and they have a really tight, close relationship. But when the business is sold and suddenly there's $50 million that gets dropped into the checking account, it's very difficult for that advisor to maintain it when they come up against the big banks as the competition. And I think this is something that really should be considered when you're doing your practice and when you're thinking about investment management. How can you position your partners and who you have as part of your broader team that allows you to make sure that before these events take place, you've already made sure that your clients view you as the quarterback and the key person in their financial relationship. Whether you do all of the jobs or whether you outsource some of these jobs, they view you as the key person that they're going to go to for advice. And that's the important thing. The advisor wants to be looked at as the point of contact for all holistic advice. The last thing I do want to call out before I change the slide is just really in the middle of this slide. It's something that I think we are trying to do a better job on, and it's something that everybody needs to focus on. And that's the role of making sure that when you're discussing goals and aspirations and financial plans, that you're talking to both spouses. I think one of the mistakes we've done in the industry over the last number of years is we've always talked to the husband. And what that happens in the high net worth space is that over 80% of females fire the advisor when their husband passes away and they get a new advisor. So that's 80%. These are clients you already have. And so it's something you really have to focus on and make sure that you're having discussions with both sides. Because as my wife will tell anyone who listens, actuarially, she will outlive me. So they should make sure that they're talking to her because she's going to make the final decision because I'll be gone. So it's something that I think all advisors really need to focus on. So as complexities increase, and I think clients look for a lot of advice on a different level as they get higher net worth, I don't think they expect the advisor to know everything about everything. And I think that's really important. What they do want is they want a single point of contact they can trust, that they can lean into, who can then farm out portions as required, whether it's business succession, whether it's tax and estate planning, or whether it's alternative investments. All of these things are something that they want somebody they trust to be able to coordinate things, but they don't have to deliver it themselves. And that's generally where Manulife Private Wealth comes in, to try to work with the independent financial advisor in order to deflect and maintain these assets away from some of the larger firms. So what are Canadian high net worth investors looking at right now? And what's the major concerns? Well, I mean, this chart I love. It's going back from Bank of England data, and they've gone back in interest rates for the last 5,000 years. Didn't know they wrote everything down, but apparently they did. Right now, we've got incredibly low interest rates. And despite the slow recovery of the economy and what we're seeing in North America and some very slight inflationary pressures, we're not seeing a quick bounce back on interest rates. What does this mean for high net worth investors? High net worth investors historically have used the income flow coming from their portfolios for their lifestyle, for maintenance, and for giving away to charities. Now, obviously, on the lifestyle things this year, that hasn't been as impacted because I don't think any of us have been traveling the same way we used to or spending the money. But that being said, people are looking for where they can put the money. And the challenge right now is when you look at return and sovereign debt and you look at bonds, Europe is still in a negative yield situation. Canada is obviously positive, but it's still pretty miserly. And I think they're really trying to figure out what can we do to try to facilitate something that will give a better return in the fixed income space. So the way we work within Manulife Private Wealth is we do look at 5-year modeling for returns. This is just a snapshot, and it's very small, so I will apologize, but I will share it in case anybody's interested. But what you can see is when you look at institutional grade bonds in the US, their negative yield on Canadian dollar terms in total on the 5-year forecast. When you're looking at something like Canadian investment grade bonds, you're just barely above zero. And this is a 5-year forecast. So I think, you really have to look at diversifying your asset classes and trying to give a return for your clients, because historically what Canadians were brought up with is they would look at a balanced fund, and quite frankly, a 50% bond portfolio is going to give you a very negligible yield without dramatically increasing the risk curves. So Manulife Private Wealth, I thought we'd walk through and explain what we do. We're a discretionary investment manager. Manulife Private Wealth is part of Manulife Investment Management. Manulife manages about $1 trillion of assets across the globe. So we're a substantial global presence. Right now, Manulife is approximately 1/3 in Canada, just under 1/3 in the United States as John Hancock, and just over 35%, in Asia. What we do and the way we were created is we manage money the same way Manulife manages its own balance sheet. What I mean by that is, for those of you who are insurance agents, when you sell one of the life insurance policies, Manulife takes in a premium. That premium has to be invested because the death benefit needs to be paid out. So over the past 140 years, Manulife has built up a strategy of trying to get a stable, steady return in order to fulfill its obligations while giving itself a return on the investment. The key on this is it's an institutional portfolio approach. It's a very conservative, very, very long-term approach. And this is the sort of checks and balances that Manulife Private Wealth has built in order to try to look at their own money. We use something called goals-based investing. It's become a very big industry catchphrase. We actually build portfolios to specific goals. And what I mean by that is, if a client has one goal that it's philanthropy for a 10-year time frame, we're going to build a portfolio based on that. If we're going to build a portfolio that's for retirement, for example, my own retirement, that's going to be based on my children, 35 years from now, I'm going to build a goal for that. And I think the real key on that is, rather than doing it as a risk-based approach where you do a questionnaire, you add it up, you get a 27 and you're balanced, that doesn't really tie behavior. And one of our previous presenters mentioned this. We find goals-based investing forces our clients to lock in what they're thinking about to the actual goal. And so when we saw the market downturn that took place last March, our clients were not becoming agitated, because when you're looking at something and they know that that goal is being tied to a 16-year performance, they don't care if the market has had some fluctuations. They're not thrilled about the market having fluctuations, but we're trying to make sure that overall it's being mitigated and tied to that. And it takes out some of the behavior. And I would say this behavior is something that you can really focus on and work with all of your clients. It's not just for high net worth clients, but you can also work with your mass affluent clients to make sure that you're trying to tie what they're doing to those individual things rather than chasing returns. Because if they're chasing day-to-day returns, they're going to turn into the people going on Robinhood, buying GameStop, and it's not really investment management anymore. The last pillar of Manulife Private Wealth is open architecture. Although I and my team are licensed as portfolio managers with Manulife Investment Management, we're an open architecture firm. We don't feel that any one firm does everything really well, which is why we use institutional managers from around the world on our portfolios. One of the key differentiators for Manulife Private Wealth is when we focus on things, we use an asset allocation team. The asset allocation team for us is based in Canada, the US, and Asia. They look at 5-year forecasts. One of our prior presenters also concentrated on this. Is for high net worth clients, we're not chasing return. We're trying to protect money, because our clients have made their money and they're trying to get a reasonable return, but at the same time protecting downside. So what we're looking at is we're trying to get a overall best possible return for a 5-year yield with the lowest standard deviation. And so what happens is we'll come up with 30 different asset classes. We'll look across the spectrum and we'll come up with the asset mix that will match that client goal. And an example of that might be, if it is using philanthropy again, 15-year time frame, they need a 4.8% return. We're going to give them the asset mix that gets them that 4.8% return. We're not going to be chasing anything higher. The active investment managers that we're going to utilize will try to improve on that. We do have a due diligence team that does our manager research for us. So we are picking and choosing within this manager due diligence. We have different styles within this manager selection. So for example, in the US equity side, we have Manulife Investment Management, we have Aristotle, which is a value manager. We have Brown Advisory, which is a growth manager. We feel that having these different style selections and these different managers is really important because as markets go through their different cycles, some are going to have better benefits than others, and we have the ability to fluctuate. Most of our clients, we invest their money, we use separately managed accounts. And what I mean by separately managed accounts is that those accounts are actually buying individual stocks and bonds. It's concentrated portfolios, but it does allow us to switch between managers without having to sell the entire fund. We do this because it's just a tax efficient way of investing our clients' money. Most of our clients' money is not in a registered portfolio, so we have to be cognizant of taxes. As much as everybody wants to send a check to Ottawa, we try to defer it as long as possible. One of the things we really focus on when we're looking at investment management, and one of the things that tries to align us with how pension funds look at things, is alternative assets. So when you look at a pension fund, and I'll give the example of the Canada Pension Plan, or you could do Ontario Teachers in Ontario, their portfolios are made up of approximately 30 to 40% alternative assets. And why are they using alternative assets? And it's not dissimilar to how Manulife uses them with its own balance sheet. If you have a very, very long time frame, you can allow yourself to have a liquid assets that will give you a very stable return that aren't as correlated to markets. And that's where we start looking at the opportunity of using private assets within Manulife private wealth portfolios. So what are private assets? Well, when you're diversifying private assets, you're really looking at a series of things. They're real intrinsic assets. So rather than buying equities in a company or bonds from the government or a corporation, you're actually buying the underlying asset. So the best example on this list in my mind, for any of you who have filled in forms, Manulife is the largest private owner of timberland in the world. When I came to Manulife 6 years ago, I was convinced the reason we were is because we made so many forms out of paper that we needed our own supply of forests. What it actually is that overall it's a very stable product. It has a very long time frame, obviously, because you have to grow the trees and then harvest them, but you're trying to get a set steady return. And so this isn't really tied to the overall marketplace. And I think that's really important when you're looking at volatility. These are income replacements to try to give stable return to clients. Other examples would be infrastructure. For those of you who've been in the Greater Toronto area, the 407 highway, which is a private highway, that would be an infrastructure build. The return on that product is obviously the tolls that are being taken place. Other examples are oil and gas, farmland, and real estate. When I say real estate, I'm not talking about residential real estate. I'm talking primarily about commercial real estate. It could be industrial, it could be warehouse, it could be office building. These are the type of things that get invested within the real estate segment. So why do you want to invest in passive investment? Well, I think investors look at these, and institutional investors look at these as diversification that they can get. It gives them a stable income source, and it gives them a long-term income source. You're trying to get something that gives you very low volatility. When you're doing this, it tries to give you an ongoing income supply. But the big caveat I will say within the real asset side that is important to high net worth people, and it's more important to anybody who's just dabbling in this, is liquidity management. And what I mean by that is when you're going into alternative assets, historically, it means that you're into something that does not have liquidity. Most of our vehicles are a minimum of 1 year lockup. Many are longer than that period of time. So for a client who's looking to invest in this portfolio, when in high net worth space, we're looking at somebody who's generally using between 10 and 15% of their assets. They'll use their liquid assets, which is their stock and bond portfolio, to actually have their day-to-day expenses. But this will give them some diversification and some long-term access to some known correlated assets, while at the same time making sure that it's giving them the overall portfolio they need. One thing I will say within liquid alternatives is there is a great effort right now of coming out with some liquid alternatives in the marketplace. The challenge right now is the liquidity sleeves, and generally a liquidity sleeve is something that is a daily tradable series of stocks, bonds, or derivatives in order to get clients to have funds coming in and out. That just generally means that the alternative asset is no longer as diversified or as non-correlated as it once could be. And so within Manulife Private Wealth, we try to stick to institutional approach, and we try to stick to actual real assets on that side. So just overall for why you would want to do it on some of the returns, you can see they have stable returns within some of these product classes, real estate, farmland, timberland. The goal is just going to be an ongoing stable return without a lot of fluctuation. And I think I can show you this on the next one. When you're looking at diversification, when you're looking at the standard deviation on the risk profile, you can see that the timberland side of things is the closest over to the US Treasury bill for the risk. So it's trying to give stability to our clients, give them some diversification, and give them something for an overall yield, because as I showed in some previous slides, you are not getting that yield presently on fixed income. So how do we do it? Within farmland is a good example. It's a combination of appreciation and income. So farmland's an interesting asset class. This one's a US-based one, but the same application would hold true in those provinces where corporations are allowed to buy in Canada. What it is, it's a combination of income, and the income stream is coming off of the crops. And so by having the crop diversification and having multiple different scenarios, you get a stable payment out, which isn't going to be fluctuating if you're tied solely to canola or one of the other crops. And then the second stream that you're going to get is capital appreciation, because what we're seeing is historically farmland has been continuing to go up in value. We have seen consolidation within the farm industry where farm sizes continue to get larger and larger. And as those buys are taking place, the values continue to go up. So it's a combination of the two factors, but the income stream is very important in the high net worth space. And that's really where we're concentrating on our clients in order to make sure that they're able to obtain that level of wealth. So just to talk about a couple of the products that actually exist within Manulife that we utilize within Manulife Private Wealth. We use the Manulife Canadian Real Estate Fund. Any of the large institutional real estate funds would be the same. I think it's just important to call out the diversification. Canadians have had a subset over the last 10 years that real estate is their house. A house is not an investment unless you're willing to sell it and go somewhere else. So it's generally somewhere you live. So if you're looking at a real estate investment, you're looking at something that's a diversified holding of various types of real estate, be they warehouse for Amazon, be they industrial, be they office building, and each of these will add something to the mix. And we want to make sure that when we do them, we're looking at something that has long-term leases with tier 1 tenants. So for example, one of the buildings in downtown Toronto, the key tenant is the Bank of Canada. They're going to pay their bills. So we're not worried about the government not paying the bills. Another we have is Bank of Montreal. They, again, are going to pay their bills. Within the real estate fund, we use something that is generally just a diversified asset class. It uses real asset, timber, mortgage, timberland infrastructure. So it just gives everything to the client in one option. And then Bonnyfield is a Canadian farmland fund, which focuses obviously on buying and upgrading Canadian farms and giving a real return on those Canadian farms to our clients. And so these are just considerations that you think of within your practice in the high net worth and things you want to talk to your clients about. And what I really wanted to emphasize today is that it's not a conversation you want to have with your clients after the fact, once the sale of the business has taken place and it's already gone to been not deposited with, BMO or Scotia. You really want to have these discussions on long-term planning and what they're going to do with business transitions as part of a holistic advice platform that you're giving as an independent advisor. And whether you position yourself as the person who will actually manage that money or whether you're going to introduce a trusted partner to assist you as a partner on this relationship, that's your choice. But I think it's really important that you get viewed very quickly as the relationship manager for the holistic family view if you plan on pursuing the high net worth space. because they have many options and they will be pursued heavily. So I think, Manulife Private Wealth is there to partner with independent advisors. If anybody does have any questions, I'm happy to answer them. And then if anybody wishes this presentation at the end, please feel free to reach out to us, and we'll happily share the presentation and answer any questions you have.